Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Jodka, National Director of Capital Markets Research at Colliers, to discuss commercial real estate investment trends and what areas within the space are most attractive for investment. Aaron, it's great to have you with us. Welcome to Trade Talks.
Thank you.
All right, you got it. Let's start with the macro backdrop. How will recent federal interest rate hikes impact the real estate market? And will the hikes have an impact on fluctuations in U.S. currency?
Well, it's definitely having an impact on transaction volumes. The borrowing costs for real estate investors has roughly doubled from a debt standpoint in the last several months, and that's really causing friction in transactions. So we're seeing a bid-ask spread between buyers and sellers. Sellers are not really willing to take a haircut because their properties are performing very, very well. Fundamentals are incredibly strong. The challenge on the buyer side is, well, their debt costs have come up, and to meet their return thresholds, they're looking for a discount. So we're seeing a real sort of impasse in a lot of transactions today. From an overall currency fluctuation challenge, well, what we're seeing there is the increasing federal funds rate is causing knock-on effects in other countries, which in a lot of ways is making foreign real estate assets more attractive to US-based real estate investment groups.
What's the difference between what office investors and suburban investors are looking for in regards to ESG compliant properties, and how important is energy efficiency to real estate investors?
It's incredibly important, and we're catching up. The US is behind places like Europe, so there is room for us to continue to expand our energy efficiency and focus on that. But ESG compliant buildings are a top concern and top criteria for commercial real estate investors, particularly in CBDs, and downtown markets is really where we're seeing that push. In more dense suburban markets as well, but your more suburban, exurban markets, it is less of a focus relative to those other areas.
How has multifamily overtaken industrial in the asset choice wish list for investors, and will multifamily properties continue to be a safe investment for years to come?
Multifamily is incredibly popular. It has been the most liquid asset type for a number of years. Surveys show a real interest in industrial as well, but most recently, our investor clients are starting to look to multifamily as their top choice when selecting, between all the different asset classes. And yes, it will be considered a safe asset type given strong fundamentals, high mortgage rates. It's very challenging to buy a home today with the down payment, with the cost of homes, and the lack of construction really across the country. We are a vastly underhoused nation, and that's going to continue to put really strong tailwinds behind demand for multifamily assets.
How much does the popularity of e-commerce drive the demand for last mile distribution properties, and what other aspects led to industrial being considered a commercial real estate darling?
Oh, it's been an amazing run for industrial from a fundamental standpoint. Rents have never been higher. Vacancies have never been lower. It's been absolutely phenomenal for performance. And e-commerce has been a major driver of that. The way we shop, the way that we interact with commerce has shifted. And I expect my packages to be here within the day, if not 2 days. Oh, God forbid it's 3. So we've shifted that, and that's caused so many retailers to come in and need that location close to where people are living to distribute very, very closely. So last mile has been such an important driver, and those rents and those fundamentals have been even stronger. So that's outperformed a broadly well-performing asset class. So that is looked to as another key area for investors.
Let's talk about the shift that we're seeing in anchors, which I always think is interesting to watch how this plays out. What makes a grocery tenant the most attractive anchor for a retail property, and will landlords remain bullish on grocery tenants into 2023?
Well, it's one of the most challenging e-commerce industries to sort of penetrate. While you can have pickup and delivery, at the end of the day, you're still essentially distributing that food from that location by and large. And most people, everyone eats, right? Everyone has to eat. And we are seeing more trips to grocery stores than before. A generation ago, you would see one shopping trip, pick a day, fill up the grocery cart. That's what you did for the week. Now we're shopping more frequently, less large meals in terms of that. I'm bringing 2 grocery carts through the checkout line. It's what do I need today and tomorrow, and then I'll go in a couple more days. So that's causing a lot of foot traffic, and that's a really strong driver for those grocery anchored tenants, or excuse me, grocery anchored centers, because you have such strong just general traffic in those centers. So it helps the nail salon, it helps the bank, it helps the toy store, it helps all the gift stores and everything else that's in line, really drive some solid activity.
Why are hotels expected to outpace other asset classes in 2023? And what makes luxury hotels such a coveted asset?
Well, luxury hotels have outperformed since the pandemic. In the early stages of the pandemic, it was really the most challenged segment of the marketplace. We really saw the extended stay grouping of properties really vastly outperform. Well, since then, we've seen RevPAR, which is revenue per available room, soar. Room rates are at all-time highs. Occupancies are increasing. We're seeing more business travel. This is really driving more activity on the upper end of the scale, and people are traveling again, right? They're going out to those vacations. They've got pent-up demand, and those asset types and those segments are really doing very well. So we expect that segment of hotel to outperform. Though relative to the other asset classes, hotel should expect to see lower volume as it historically has.
And Aaron, I have to ask you, because we're asking all of our strategists coming on talking about their 2023 outlook. Will inflation woes begin to ease in the new year? And how are snags in the supply chain continuing to drive up inflation?
We do expect inflation to ease in 2023. I don't know if we get right down to 2% by the end of this time next year. We're hopeful that we'll continue to see some real momentum there. But yes, we do expect to see inflation continue to become less of a story over the course of 2023. And from a supply chain standpoint, that's vastly improved. We don't have the stories any longer of hundreds of ships waiting outside the ports of LA and Long Beach just to drop off their cargo. We're seeing those production lines really start to pick back up and normalize. And it takes time. We shut down our entire economy for a period of time, and it does take we have to reset that, restart that, and we've done that. So the supply side pressure is less of a concern. It's more so on housing and gas and other aspects of the economy.
And you had mentioned earlier tier 2 cities. Why are US based investors focused on tier 2 cities like Austin, like Seattle? What unique advantages do they offer investors?
Well, we have a lot of growth cities in this country relative to other parts of the world. So these second tier cities are growing rapidly, have strong demographic trends with migration, job growth, lower cost of operation. And that's very attractive to a variety of companies and occupiers looking for real estate across the spectrum. So they are a darling when it comes to real estate investors. And we've seen more and more of volume shifting to the southeast and southwestern parts of the US, the Smile States, the Sun Belt, relative to other aspects and other parts of the country.
All right, Aaron, we appreciate your insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.